Hi, are you interested in learning more about what's included in the monthly mortgage payment? Are you a first-time home buyer and just trying to figure everything out? Well, listen, my name is 𝐒𝐫𝐢𝐭𝐿, real estate agent here in Nashville, Tennessee, and I help first-time home buyers realize their dream of home ownership. So today we're doing a quick, simple video, and this is going to be one talking about what's included in the monthly mortgage. So stay tuned to learn more about the monthly mortgage. All right. So today we're going to break it down, okay? So included in the mortgage is several different items that you need to be aware of because this does impact the amount of house you are approved for because all of these items are added together. All right. So first, let's talk about the principal. So if you look at this list, the things included is your principal, interest, property taxes, homeowners insurance, mortgage insurance, and down payment assistance repayment. And that's going to be very important to keep in mind. All right, so let's start with the principal. The principal is pretty simple. It's the amount of the house that you're buying. That's going to be split into, 12 monthly payments a year divided by the number of years that you're going to have that mortgage. So that payment would be your monthly payment. Now, interest, you'll see a lot of the statements may say PI together and give you one amount. So that's your principal and your interest together. So the interest, of course, we know that right now, for instance, this is 2022, January, well, this is actually February now. And we know that we've had record low interest rates. However, they are starting to climb. So what you want to make sure you do as a first-time home buyer is to go ahead and get quotes. Don't ever take just the first one that you get when you speak with lenders. Get at least 3 quotes so you can see who's offering the best rate because it impacts your monthly mortgage. It also impacts the amount of house you will qualify for because if the rate is higher, then your payment will be higher, and then that will in turn probably decrease the amount of house you could actually purchase. So it's very important. Property taxes. So we know that that's something we cannot control as far as the property taxes, but where you could have a little bit of control is based on where you live and the type of house that you purchase. So, like in my area, we know that certain counties may have higher taxes and some counties have lower taxes. We also know that some counties have a state and like a county taxes. So they may have two type of a city and county. Just really be mindful that on top of the price of the house, you have to know if that particular area has higher taxes. Because if it does, that's going to impact that mortgage payment. Next is homeowners insurance. So this is an area that, of course, you have to insure your property, insure your house. So every mortgage that has a loan is going to have homeowners insurance. So for that, again, you can get quotes for different homeowners insurances when you are getting your mortgage. So it's very important. Quotes are going to be essential. So make sure you get quotes. You can compare what they're offering, like the dwelling coverage and those things, personal property coverage, and with their price to ensure you're getting the best deal. All right, and then you have mortgage insurance. So homeowners insurance is for your house, but mortgage insurance is a fee that you will see on your monthly mortgage when you don't put down 20%. Now we know that not a lot of my clients are not able to put down 20% on a mortgage if you have an FHA and a conventional loan. And that's okay, but just keep in mind that when you don't put down 20%, the mortgage company have an insurance that they attach to your monthly mortgage. And that's how you may see PMI for private mortgage insurance, or you might just say mortgage insurance, but they're pretty much the same thing. And that is to protect that investment for them. Okay. All right. So you're going to see that amount on there. Now, I work with a lot of first time home buyers, and because we're not putting down, that 20% or don't have the money to put down, rather, a lot of times we use down payment assistance. Now, here in Tennessee, we have a few options. If you're using, what we call THDA, we have the Housing Fund, and then we have another one called 𝐁𝐫𝐢𝐭𝐭𝐨𝐧, are just three of the options. A lot of times, down payment assistance, you do only get it when you're a first time home buyer, but it's not free money. It's not, in most cases, it's not grants. You pay back that amount over time. So you will see the repayment amount included in your mortgage if it has a repayment amount. THDA, for example, they're now offering in 2022, because they change it all the time, they are offering two options. They're offering one that is a 6% that you will repay back monthly, 6% of the sales price. They would give you that in the beginning, and you pay it back monthly. And they are offering an option that is $6,000 that does not have the monthly repayment, but you as more so pay that at the end if you sell the home, and it may be forgivable after a certain amount of time. So those are the two options for that particular program. But in most cases, if you go with the higher one or if you go with other programs, you pay it back in your monthly payment. So that is really important to keep in mind. Okay. Now, there are some local banks, especially, that offer what you might see is a 100% financing option. Now, what they did is, you think about a pie, right? Think about a whole pie. Banks typically, that's where down payments come from. They typically lend you 97% of that pie in your loan, okay, or 96.5%, in that loan. And the other 3% or 3.5% is your down payment. That's the slice, that's normally your down payment. But when you're using down payment assistance programs, typically they're coming on top of that 97, which is your regular loan, and they're giving you the funds to cover that slice. And sometimes if you take like that 6% option, it's also covering enough to give you more money towards closing costs as well. So that's how it works in most cases. But there are some local banks that may have a program that says 100% financing, where they're covering the whole pie. In that situation, you won't see two monthly payments, it'll be all in one. But what you will see possibly is maybe a higher interest rate for those programs, but it's important to look at the bottom numbers. So if they have that program, I always recommend getting a quote for that program, as well as a quote for the THDA or whatever other down payment assistance program that's available, so you can look and see what that amount looks like. Can you come up with the closing costs to cover that, to save some money in your monthly mortgage if you're going to get the 100%, or if you just take the 6,000 that THDA is offered that could be forgivable, are you then going to, can you come up with the difference in the closing costs on that one to cover the rest? If you cannot, it's no worries. There are options out there to cover more, but it does increase your monthly payment. Okay. So I want to give you an example on the next slide here. All right. So let's say in this example here that you're going to get a loan for a mortgage for $290,000. All right, the principal and interest that's combined is $1,162.45. So if the lender that you're working with don't give you a true breakdown, you may think, "Oh, I just got to pay 1162 for my mortgage." And no, you do not. You pay more, okay? All right, so let's go to the next one. So insurance. For this amount, they've estimated, and this is all estimates until you actually get a quote and go under. Once you go under contract, you will get a quote for like your homeowners insurance. Then you can kind of determine what that actually monthly payment would be. But $115 is what's estimated here. To kind of give you further explanation on the insurance and taxes, what it is called escrow. So what happens is, when your mortgage, these are paid by your lender every year, right? So when it's time for that to renew, your lender is paying your homeowner's insurance and your taxes for you. So they're taking it, so they're collecting the money every month as a part of your mortgage. And then when these items are due, they then go ahead and make that payment for you. The very first payment that they make for you, they collect that money at closing. So that's a part of what the closing costs are. Part you'll see prepaid on your estimates, and that is paying for that first year of that homeowner's insurance and the taxes. And then after that, they take it out of your monthly mortgage every single month, and they set it aside so they can pay it the next year, the next time that it's due. So that is why that's in your mortgage. So your homeowner's insurance estimated could be around 115. Taxes, of course, that's going to be based on the things I mentioned earlier, which is, where you live, and are the taxes higher, are they lower, things of that nature. So that's estimated in that. And you get this in the beginning. Then the mortgage insurance. This is the one I was telling you that your bank actually will charge and it attaches to your mortgage. And then in this case, if this is all the first items. If you didn't have down payment assistance programs, then this would be the amount for this price of a home here in Davidson County. This could be the amount that your mortgage would be if these are estimates. Well, these are estimates, so it could be about $1,623.71 for your mortgage. Okay. If you use down payment assistance programs, your lender can tell you upfront before you even go into contracts. I always recommend getting this information in the beginning, but they can tell you what your estimated payment would be if you included the down payment assistance program. In this example, we used the 6% down payment assistance. And so it gave the buyer quite a bit to go towards their closing costs and down payment. And so the monthly payment would be $118, which attaches to this. Now, they're going to attach it all for approval purposes. However, you may pay them separate. You may pay two separate payments. That's why it's listed as a first mortgage and a second mortgage on this example. So the total that they will look for in a pre-approval and to determine if you'll be approved for that 290 is 1741. This would be the amount of the mortgage. So what they look for is to say, okay, if you're going to do this, then this is how much house you qualify for. All right, it's an example. You might qualify for more and just deciding this is your purchase price, but this tells you how much your mortgage payment would be for that once all these items are included. So if you're doing research and trying to figure out, what do I need paying the mortgage, just be mindful. Make sure that when you're doing your research, you're not just stopping here. Because if you're using one of those calculators that only give you this, then you might think that's all you pay monthly, and actually there's more. Okay. All right. I wanted to take a few minutes to break that down. Again, this is 𝐤𝐫𝐢𝐭𝐭𝐨𝐧, real estate agent here in Nashville, Tennessee. If you have any questions or if you're interested in being a homeowner, I would love for you to contact me, and I'd be more than happy to help walk you through that process. Thank you so much and be blessed. Bye.